Every government has its laws. Every people have their leaders. But there's one set of rules that governs them all. Rules written not in parliaments or congresses, but behind the closed doors of central banks. They are called the Basel Rules, and they quietly decide who wins and who loses in the game of global finance.
It all began after disaster. In 1974, the world watched as a German bank called Reshaped collapsed, triggering panic across continents. For the first time, bankers realized that one failure could shake the entire global system. Out of fear, 10 nations gathered in Switzerland, in a small town called Basel, to make sure it would never happen again.
From that meeting came the Basel Committee, a secretive council of central bankers and regulators. No flags, no elections, no public debates. Their mission? To design a rule book for the entire world's banking system. It wasn't a treaty, it wasn't law, but somehow it would come to shape every loan, every mortgage, every crisis for the next 50 years.
The first Basel Accord, known as Basel I, was written in 1988. Its goal? To make sure banks held enough capital to cover their risks. For every loan made, a bank had to hold a cushion of safety, a fraction of real money, set aside as protection. It sounded simple, but this new rule quietly decided which countries could grow and which would stay poor. The Basel Committee divided assets into classes, safe and risky. Government bonds, safe. Loans to small businesses in Africa or Asia, risky. Banks followed the math, moving billions away from the poor and into government debt. The rules were meant to prevent collapse, but they also froze opportunity. By 2004, Basel II arrived, a revolution wrapped in equations. Banks could now calculate their own risk using internal models. In theory, this was scientific precision. In reality, it was a loophole the size of Wall Street. Big banks hired armies of quants to game the numbers, making their loans look safer than they were, just to lend more and earn more. Soon, the Basel Rules became a global passport. Any country that wanted access to international finance had to obey them, even if they weren't at the table when they were written. From Tokyo to Lagos, from London to Sao Paulo, every bank began living by Basel's invisible commandments. The irony was cruel. The very rules meant to make banks safer helped create one of the biggest crashes in history. By trusting models and ratings, Basel II allowed massive leverage hidden under layers of safe securities. And when the subprime bubble burst, those same safe assets brought the world to its knees. After the 2008 crisis, the Basel Committee returned. They promised reform, Basel III, higher capital, tighter liquidity, and a new weapon, the leverage ratio. But once again, the same question echoed. Who watches the rulemakers? Basel's power is quiet, almost invisible. Its members are not elected, yet their decisions ripple through every household mortgage and small business loan. When Basel says hold more capital, credit tightens. When Basel says ease liquidity, markets boom. They control the rhythm of money itself. The Basel Rules favored the big and disciplined. Large global banks adapted quickly. Smaller banks in developing nations suffocated. A farmer in Kenya, a startup in Brazil, a craftsman in India, all affected by rules written in Swiss conference rooms they'll never see. Basel claims to be neutral, a scientific shield against chaos, but every equation has values hidden inside it. The rules of risk aren't laws of physics, they're choices, and those choices shape who gets credit and who gets left behind. Not everyone played by Basel's rules. As regulations tightened, Finance simply moved into the shadows. Hedge funds, private equity, offshore credit. The system adapted. Basel tried to guard the gates, but the castle had already built secret tunnels. Today, Basel IV is coming, promising final reforms, new calculations, new ratios. But the real story hasn't changed. Every new rule breeds new strategies to bend it. Finance, like water, always finds a way. From New York to Nairobi, Basel defines what's possible. Governments may print money, but banks decide where it flows, and the Basel Committee decides how they must behave. It's an empire without soldiers, only spreadsheets.
The Basel Accords gave the world a sense of safety, a promise that numbers could tame greed. But risk is not just a formula. It's human behavior, ambition, fear, and pride. No regulation can erase that.
Few people know the faces of those who sit at the Basel table, yet their word moves trillions of dollars every day. No headlines, no elections, no debates. This is power in its purest form, quiet, constant, and unchallenged. As digital currencies rise, as central banks go online, Basel faces its greatest challenge: how to control money that knows no borders. The old rules were written for gold and paper. Now, the game is coded in algorithms. Who writes the next Basel for a digital world? The Basel Rules remind us that power often hides in plain sight, not in speeches or armies, but in spreadsheets and formulas. Behind every economic boom or bust lies the silent logic of these accords. We may not see Basel, but Basel sees us, and every credit score, every mortgage, every loan. At its heart, Basel is built on one fragile thing: trust. Trust that banks tell the truth. Trust that regulators act fairly. Trust that the system can correct itself. But trust is not infinite, and once broken, no rulebook can rebuild it. The Basel Rules were born from fear, the fear of collapse. And yet, every time they evolve, they create new cracks. Perhaps the lesson isn't in their perfection, but in their paradox. That trying to control risk is the riskiest act of all. The Basel Rules didn't just rewrite global finance, they rewrote the language of money itself. And as the world chases digital dreams and economic empires rise and fall, one truth remains: the rules may change, but those who write them will always rule.